I'm going to be running through, I'll try and keep this relatively short as we're so late, but I'm going to run through some charts, and I'm going to start with the US situation and the global situation. So the first chart on this presentation is the VIX index, which basically represents risk aversion in global stock markets. And what you can see in this chart is the so-called VIX compared to previous episodes or crises. So the VIX has risen hardly at all in this this time around compared to a year ago.
Apologies, let's try this.
When we had the announcement of the Trump tariffs, and the reason there's been such a small gain in the VIX index and why markets have been so resilient is that most people in the markets have been assuming ever since this Iran crisis or war began that that Trump was going to. The term is TACO. Trump always chickens out. That was the term which is very popular in the US, and so the markets have basically most of the time been trading on TACO. That means if there is a deal and the situation is resolved, a lot of that is already discounted in the US market, whereas if this assumption proves wrong and the Straits of Hormuz is still closed in 2 months' time, then at some point we're going to have a big sell-off in world stock markets, particularly the US stock market. So for now, the most interesting development is that the bond market has started to behave negatively, but the stock market is still acting like a deal is going to happen at any time. And frankly, like most other people in the markets, I've been assuming that Trump was going to TACO too. But there again, I never thought he was going to attack Iran in the first place because I couldn't understand. I thought it was a very risky move for himself domestically, because attacking Iran, while it suits the Israel agenda, in my view, is very risky domestically because all the polls show that the Americans are against the Iranian war. The polling on the war is worse than at the worst point in the Vietnam War in the US. Meanwhile, Trump's polling on managing the American economy is at very low levels, even though the US stock market is at an all-time high. So clearly Brent crude oil has gone up a lot, but it can go up a lot more if the Straits of Hormuz is still closed in 2 months' time. And we aren't at a high enough level yet to cause demand destruction. In the big picture, this shows America has a huge dominance of world stock markets. My formal view is that America made an all-time peak as a percentage of world stock market capitalization at 67% in late December 2024. My guess for now is that is an all-time peak. That's a huge weighting of the world stock market index. China, the second biggest economy in the world, only has a 3% weighting. So my base case that will represent an all-time peak is partly driven by the view. Doesn't mean that the US stock market has to collapse, but it does mean that the US dollar has entered a long-term downtrend, which is my base case. The next chart refers to the MSCI World Stock Market Index ex the US. So that's all markets excluding the US. And what this chart shows is that last year we broke out of a trading range we'd been in since 2008. So that breakout out of a trading range is a positive signal for world stock markets ex-US relative to the US. I'm going to jump over the couple of charts. So the reason the US stock market has done so well in the last 10, 15 years is clearly the dominance of big tech. These big tech franchises like Google, Facebook, they're not just dominant in the US, they're global franchises. But this means the US stock market's gains have been very concentrated in a relatively few stocks. And in the last 3 years, it's clearly been driven by the AI theme. So the four major hyperscalers, which is Alphabet, Microsoft, Amazon, and NVIDIA and the four hyperscalers account for an estimated 43% of the gains in the S&P 500 since the beginning of 2023, when this AI thematic entered markets. The signal for the AI theme to enter the US stock market and world markets, or the catalyst, was the Microsoft investment in OpenAI. And that triggered what I've been calling ever since the AI arms race, because these big tech companies in the US, when this AI story arrived with the emergence of OpenAI and these AI language models, it triggered a decision on the part of these major companies to launch these massive investments. And the reason they did it was as much negative as positive. AI is the big next growth opportunity, but from the standpoint of a Facebook, a Microsoft, a Google, these are also a huge potential source of disruption. So what's been going on in the last 3 years is huge increases in capital spending by these big tech companies. And I've got the key chart on this is this one, which shows the rise in CapEx. And when we did this chart recently, based on the latest earnings guidance by the four companies, Microsoft, Amazon, Google, and Facebook, or what they call, Facebook's now called Meta, we're looking at a projected 680 to 700 billion US dollars of CapEx this year by these four companies. So this is enormous. And what's going on in reality, these major big tech companies in America in the last 10 years or more, the reason their stocks have done so well is because they had asset-light business models, and they were each in their own moat or segment, and they weren't competing directly with each other. That was the situation until the beginning of 2023. Since then, what they've done is they're all converging on the same AI area, and they're all spending a lot of money, so they're basically exiting their moats. In fact, they're draining their moats because they're spending all the money, and they had this huge amount of cash when they entered this situation. So if you look at the next chart, this is four major hyperscalers, CapEx to revenue or operating cash flow. We're now projecting, we've seen a huge increase in CapEx relative to both revenues and operating cash flow. So that's why markets are beginning, I emphasize only beginning, to get concerned about whether they'll be able to earn a return on the CapEx. So actually the people who have really made the money in the stock market in this whole AI cycle so far is not the hyperscalers, it's not the people who are spending these vast sums of money. The people who are making the money are what I call the AI picks and shovels. They're the people who are benefiting from the CapEx, and that is the tech hardware sector, the semiconductors, because that's what the hyperscalers are investing in. And that's why NVIDIA in the first 2 or 3 years has been the best stock to own. And more recently, we've seen huge gains in the share prices of the oligopoly through the 3 companies who dominate DRAM production globally. 2 of them are in Korea and 1 in Taiwan. Meanwhile, my base case is that AI will end up being is a very important technology. It's going to change a lot of things, but in my view, the risk is it becomes the opposite of what the internet economy was, because the internet economy was turned out to be a winner-takes-all model, where the people there was a huge network effect for the dominant franchise. Best examples of that globally are Facebook and Google. Obviously, search has been a phenomenally successful business model for Google. So it's a winner-takes-all network effect. In my view, the risk on OpenAI is it's going to be more like an airline industry. It's going to be very CapEx intensive, and it's not clear what is the differentiating advantage of all these different AI business models. So from the personal market standpoint, we don't clearly have a clear winner. It's a different story in the corporate market, where I think you've got evidence of monetization in AI is in the corporate market with Anthropic, because corporates are each going to want to have their own small language model with their own specific proprietary database tailor-made for their own use, because that's where I think you can make money in AI. But on the personal market, I'm skeptical. But what's been going on in the last few, what's been going on ever since Google launched its Gemini product, you can see on this chart that while OpenAI, which was the dominant large language platform before Google launched about a year ago, basically OpenAI has been losing market share to Google ever since. Meanwhile, the other interesting issue raised by OpenAI is what's going to happen to software. So the real money in terms of tech stocks since this AI story began has been made in the hardware, particularly the semiconductor makers, but we've had a big sell-off in software. So many years ago, in about 2011, a famous Silicon Valley venture capitalist said that software will eat the world. That turned out to be correct. Now the issue is whether AI will eat software. And as for the US economy, basically nearly 50% of the growth in the US economy last year and first quarter this year has been driven by AI capex. In the big picture, obviously the market focus is on the US stock market when it comes to AI. But in my view, and the long-term winner in AI could turn out to be China, not the US. There's two things you need for AI. You need compute and you need energy. The US is ahead of China in compute, but much less ahead than it used to be, because the US, in my view, made a strategic error a few years ago when it tried to stop the Chinese buying the American advanced semiconductors, because that move was a massive incentive for the Chinese to upgrade their semiconductor expertise, so they ceased to be reliant on the US. And so obviously the Chinese were banned from buying the most advanced NVIDIA chips, for example. The signal or message coming out of Beijing in the last 4 or 5 months is they no longer want NVIDIA chips, precisely because they want to make sure they're self-reliant. Well, so while the US is ahead of China in compute, it's less ahead than it used to be, but on energy, China is massively ahead of the US. So this chart shows increases in power generation capacity in China and the US. The green bar is China, the blue bar is the US. So it's just massive increase in capacity in China relative to the US. And the next chart shows the total electricity generation capacity between China and the US. And you can see China is way ahead. Why is China so far ahead? Because China has done a brilliant job scaling up its electricity grid and utilizing the most advanced battery storage technology, where the key company is CATL. And what that has meant in reality is that China has more or less solved the problem of renewable energy, which is storage. And the word in China in the last 2 years has become clear that solar energy in China, because of the economies of scale and the battery storage technology, is cheaper than coal. So that's a huge advantage. Another huge advantage China has is in so-called rare earths or strategic metals, where the Chinese have a more than 90% share of refining capacity. What this chart shows you is the decline, inflation-adjusted decline in the value of a US stockpile of critical materials since the end of the Cold War. So the Chinese finally, they could have done this at any time in recent years, but they finally decided last year to apply the leverage of strategic, their grip on rare earths as a tactic against the US trying to stop them buying advanced semiconductors. So the US, I think, is now trying to do a deal where, they will say to the Chinese, we'll let you now buy our advanced semiconductors if you let us have total access to your strategic materials. But the impression I'm getting, which hasn't changed after last week's meeting between Trump and Xi, the impression I'm getting is the US has lost the opportunity to make that deal because the Chinese want to emphasize reliance on semiconductors. And obviously the interesting point from a military standpoint is the US military is dependent on a lot of these strategic materials, Chinese imports, to fight their wars. Our next chart is on the inflation. So the US inflation is finally beginning to pick up. So that is in response to the squeeze on commodity prices triggered by the Straits of Hormuz. The important point right now is that the most important market to follow in the world, if you follow one data point, it should be the 10-year Treasury bond yield. In the last week, it's broken above the 4.5% level, the 10-year Treasury bond yield, and that is a signal which it's been in a very narrow trading range over the past year. We're just broken out on the 10-year. So that if the bond yields continue to rise, that is a pressure on Donald Trump to make a deal with Iran. From a fiscal situation, the US fiscal situation is not healthy. A very simple way of looking at US fiscal situation is US net interest payments and entitlements as a percentage of total federal government receipts. They peaked at 95.6% in the 12 months to January. That's total net interest payments as a percentage of an endowment, entitlements. That's like things like Medicare as a percentage of total federal government receipts. And they're basically declined in the past 12 months to still very high, 92.7%. So we've only had a marginal improvement. This is the chart. We've only had a marginal improvement in the fiscal situation despite a big increase in tariff revenues in America, courtesy of Donald Trump's tariffs. He's now backing off the tariff agenda because the tariffs are unpopular with ordinary Americans because obviously it's Americans who pay ordinary Americans who pay the cost of the tariffs, pay the price of the cost of tariffs in terms of higher prices on the street. Meanwhile, the other point to be aware of on the US fiscal situation is that the US debt is financed very much at the short end. So 85% of US Treasury debt issuance in the last 12 months has been 12 months or less maturity. So they're borrowing money at the short end. So for this reasons, my view has been that we're in a structural bear market for G7 government bonds. We had a 40-year bull market in G7 government bonds, Treasury bonds, from 1980 to 2020. That bull market has ended. And I also think we're in a structural decline in the US dollar. So I've got some charts here on Europe and Japan. Happy to answer questions, but I think the other important place, apart from the US and the global economy, is China. But as I said earlier, the Chinese stock market, while it's the second biggest economy in the world, the Chinese stock market is only 63% of the global index. But the Chinese stock market, in my view, has entered a new bull market. But in terms of the Chinese economy, we're still in the process of recovering. We're still in the process of recovering from the move into deflation, the decline in the housing market, all of which was made worse by the lockdowns during the pandemic. So if you look at household consumption as a percentage of GDP in China, you can see consumption is still running at a very relatively low level. So President Xi Jinping is committed to boosting the role of consumption in the Chinese economy. On a 10-20-year view, that's going to mean growing consumption of services, not goods. Service consumption expenditure rose by 4.5% year on year in 2025. So consumption is growing, but it's hardly booming. Meanwhile, we've had a dramatic collapse in the importance of the property market. How do I go backwards on this? Oh, no. Yeah, that's construction and real estate sectors as a percentage of GDP. You've had a dramatic collapse in the importance of property in the Chinese economy. That was made worse by the pandemic, but actually part of this was deliberate government policy on the part of President Xi. He thought the property market was too dominated by the economy was too dominated by real estate investment. His slogan, President Xi's slogan in recent years has been to boost new productive forces. What does that mean? That means pursuing development of high-tech sectors like AI, robots, and it means China being self-reliant in all these technological sectors. So part of this collapse in real estate market is induced by the Chinese government. However, the interesting point, in the major cities like Beijing, Shanghai, prices are down 30-40% from the peak, but we do not have a negative equity mortgage debt crisis. Any other country in the world with price declines in major cities that much should have a mortgage debt crisis. The reason you don't have that in China up yet, and I don't believe you will get it, is because loan-to-value ratios, even at the peak of the property boom in China, were not over 50%. Initial evidence is that property market's beginning to bottom in the biggest cities. Meanwhile, we've got the same AI story in China as you have in the US, but the difference is the Chinese are spending much less money on the capex. So I said earlier, the 4 hyperscalers are projected to spend about $700 billion US on capex this year. China's AI capex budget is currently going to be $70 billion US this year. So they're spending much less money, more efficiently. They've got this big advantage in energy. That's why I back the Chinese to prevail, to be very formidable competitors to the US on AI. China is also going to become a tech player. This is exports of semiconductors in China, which are rising sharply. These are not at the most advanced areas of semiconductors, but the Chinese are making strides in semiconductors, and it's a matter of time before they're competing with the best players in DRAM. China is known for exports of goods, but you can see exports of digitally delivered services in China are now surging. Part of that is AI-related, Chinese exporting tokens. So 48% of China's total exports of services are now digitally delivered services. Meanwhile, China remains the dominant winner in manufactured goods in terms of being the dominant leader in manufacturing of goods. This is China's soaring trade surplus. And the other interesting point in recent years, Chinese exports have been increasingly going to what people have called the global south. So the share of exports to the G7 going down, share of exports to global south keeps rising. And net exports are the biggest driver of GDP growth in China. What about the RMB, the currency? In my view, they've started to let the currency appreciate again. My medium-term target on the renminbi is that we get to 5 against the dollar. You can see year to date we're in my view the target RMB dollar will be 5%. So basically China remains in a very resilient situation. We've just moved out of deflation, and in my view the worst of the property downturn is over. I'll show you one chart, brief chart on the boom in semiconductor stocks. 2 of the 3 world's dominant DRAM producers are in Korea. And this shows you the remarkable rally we've had in Korea. This is the performance of the Korean market relative to other Asian markets. And this shows you Hynix is one of the DRAM producers relative to the Asian index. So the biggest beneficiaries of this whole AI story, as I said earlier, are the tech hardware companies. So what's going on is all this capex you're seeing spent by the DRAM, by the hyperscalers, is going directly into the pockets of NVIDIA and the DRAM producers. I think the other big development in the last few years in terms of global markets has been the rally in gold, which accelerated late last year, early this year. And in my view, gold remains in a long-term bull market, though I think we've entered in the last few months a period of consolidation. This is the chart showing gold bullion price and gold mining stocks. You can see big gains in the last 18 months, 3 years, but we didn't make a new high on gold when the Iran war commenced, and the attack on Iran was a surprise to most people in the markets, but gold did not make a new high. So that was a signal that we're entering a consolidation period for gold. And my trading range on gold in this consolidation period is at the top of the range 5,500, bottom of the range 3,800, 4,000. But the trigger for this gold rally we've seen in the last few years was clearly the outbreak of the Ukraine war and the decision on the part of the US and other G7 countries to freeze Russia's foreign exchange reserves. So what you see in this chart here is central bank net buying of gold, and you can see that net buying of gold suddenly surged in early 23, and that was buying of central banks outside G7 buying gold because people were shocked by the freezing of Russia's foreign exchange reserves, and countries globally thought, well, if it happened to the Russians, it can happen to us. And you're seeing ongoing buying by central banks of gold ever since. So the reality is that the world is moving the world is not in a formal gold standard, but the world is moving into a de facto gold standard, which is best reflected in this chart because at current gold prices, world central banks own more gold than they own US Treasury bonds, as you can see in this chart. And the other interesting related development is the share of world foreign exchange reserves. So gold now accounts for around 25% of central banks' official reserves, up from 10% in 2018, and is now bigger than the euro, and the share of the dollar, while remaining largest, has declined significantly. So gold, in my view, remains in a long-term bull market.